Hey folks, Dan Frio here, the Mortgage Update. It is October 30th and it was Fed Day. Look what the number did. Stay tuned. We're going to cover it in detail. Don't go away.
1/4 point cut. The Federal Reserve cutting interest rates by 1/4 point to a new range of 1.5 to 1.75% for the third rate cut this year. The Fed removing the phrase that it will, quote, act as appropriate. Instead, the committee now says it will, quote, assess the appropriate path of the Fed funds rate. Two dissents.
So why the big reaction with the number today? Well, the Fed came out and they reduced the federal funds rate by 1/4, and that was kind of expected. It was, I think yesterday I was saying about 90% of the people predicted that. I went onto that bandwagon after a couple months, but I don't think they're really going to do anything further, and that's kind of what their verbiage was, and that's why the big change in rates. So let's, what actually happened today? Well, they came out and they said there's a 1/4% reduction, which again, everybody assumed that. So most of the time, that's already kind of priced into everything. But the thing that they did is they came back and replaced some verbiage in their comments. And now, when analysts follow this, it's basically word by word that they're taking from the Fed and kind of extracting that to see, what are they insinuating here? So when we look at this, it says, and replaced it with, they removed the phrase that says the Fed will act as appropriate to sustain the expansion, and replaced it with will assess the appropriate path of the federal funds rate. Well, it might not, to me and you, it doesn't really sound like much, but to Wall Street and all the bond traders and everybody in the markets, they love that phrase. So it kicked up the stock market, and it also plummeted rates. So the nice thing is, too, that inflation is in check, so there's no worries there. That could change because tomorrow we come out with inflation numbers. I don't think there's going to be anything there, but that could change. So be wary of that. So another thing is, why did they cut rates? Well, employment numbers are starting to come down, and a lot of things are now signaling that recession that a lot of people were predicting in 2020. So last month's job numbers were revised down 42,000. So it went from 135,000 employed, new people hired to 93. You're seeing in 2018, there's 219,000 people a month were being hired. Now we're at 163. So it's down. It's not good. So what happens is people don't start they aren't hiring, and then the markets get a little slow, manufacturing gets slow, unemployment starts to raise, and it's just a snowball effect. So the Fed's coming in and they're reducing rates, trying to spur activity in the economy, have people spend more money, then thus getting manufacturers and everybody back at full capacity again. Then they can bring in people and hire them, and so forth. That's the kind of the analogy behind the whole thing. You see the GDP, we're coming down slightly. So that's another, not a good signal. So all these things are kind of pointing to not so peachy news in the future. Now, what's coming up tomorrow? Well, one of the biggest measurements of inflation is coming out tomorrow. So the Fed's going to watch this tightly. So this could trigger the market tomorrow. As long as this is flat or it comes in a little less hot, we'll be fine. If it starts coming in a little hot, then there's going to be some issues with that. Okay, so you're seeing here continually to carefully float. That's my analogy too. Here's why. Let's think of a stock, for example. You had a stock right here. You bought this stock at $100. Okay, in this case, it's a bond. So you bought that bond here, and for $100. Now, within 2 days, you could sell that bond for, a profit of $100, $200, $300. Just, in 2 days. I predict we're going to see a lot of, not a lot, but some profit taking here. So we might have a little reduction tomorrow. But like I said yesterday, if you go back to my last 2 episodes, we were down in this area. I said we should be coming back into this realm right in here. And why in this range? Well, you could see these lines mean things. These lines here are the Fibonacci levels. And again, we discuss this all the time. These are like bumpers. when you're bowling, the numbers usually bounce in and out of these areas. So to tighten up these lanes, we use moving averages, 25-day moving averages, 50, 100, 200. So you can see these lines, and a lot of times you hit them, you hit them, you hit them, you hit them. See how that's there? So what we did today is we went up to this line, the 25-day moving average, and hit it. So if we break above that, our next resistance level is here. So I don't think there's a lot of room to move right now. You know, we might be in this range tomorrow, but I'm predicting, and hopefully I'm wrong, because if I'm wrong, rates are going to go trickle up a little bit tomorrow, but we're going to end up in about here. We're going to see some profit taking and just some stagnation in the market. You know, some of those numbers will be absorbed, but the inflation numbers are going to play an impact. So let's go over these numbers again. So if you're new to the channel, my name is Dan Frio. I'm a mortgage advisor in the Chicagoland area, have been for over 30 years. We follow on this channel the mortgage-backed securities market, MBS's, mortgage-backed securities. This number here is dictating the price of the bond. What did it do today? Well, it went up 36 basis points, let's say 36 cents, just for example purposes. So the price of the bond, as the price of bonds go up, yields or interest rates come down, has an inverse relationship. Okay, so the move in the last couple of days was great. We're moving up, so we're back down, or back to where we were, you know, a couple weeks ago. That's good. So again, that's what we follow here. We don't follow the 10-year Treasury, which a lot of people think they follow. They think that this has a bearing on mortgage rates. It does not. It's right here. So let's reiterate what happened today. Federal cut rates, but indicated a pause. But again, the markets like the verbiage that they changed it to. And then you can see the stock market was very pleased with these numbers, because you can see it's, despite Fed cut, here, let's go to here, I'm sorry. The Fed cut, S&P hit record numbers. Dow up 115 on rate cut. So the markets like that. It's very uncommon that the bond market rallies and the stock market rallies. So, but these are good. This was a good day, and again, the technicals are in line with us that we should stay in this range, which is good. We should be a little stagnant. I'm cautiously floating right now because I think there might be some profit taking tomorrow, but I don't really think there's going to be any big moves like we saw today. This is, believe it or not, guys, this is a huge move. So if I could be of any help to you, if you had a lender that locked you down in here, and you might want to check and see if I might be able to get you maybe 0.25% or 0.375% off in your rate, because that's what happens. A lot of people just take your application, lock you in the day of the applications. They don't monitor these things like me. That's why I say I'm a mortgage advisor. I'm not just a loan officer. I don't just take your data and stuff you into a program, lock in your rate, and run with it. I try to advise you on what's going on. So if I can be of any help, you can reach out to me at 630, take that back, 844-775-LOAN, which is 5626, or you can email me at dfrio, which is FRIO, at parksidelending.com. Do me a favor, just Google me. My full name is Dan, D-A-N, Frio, F-R-I-O, and I do the Mortgage Update. I have the Mortgage Update radio show in Chicagoland. I'm on every night on WYLL from 7:30 p.m. to 8 p.m., and I'm on WIND Chicago Radio, 7 a.m. Saturday mornings to 8 a.m. So check me out. Check me out on YouTube, Spotify, iTunes, everything of that. So take care. Have a great night, and I will see you tomorrow.